6 years ago, you started your first job and began saving money. Every month, a little bit. Today, in your account, you have $18,000. It feels good to see it. But one day you do the math. If this same money had been invested instead of just saved, how much would it be worth today? The answer might be bigger than you think. Maybe right now you're wondering, was I making a mistake by only saving all these years? If that question is on your mind too, then by the end of this video, the answer will be completely clear. And that's where a new question begins. After saving, what's the next step? In today's video, I'm going to show you the exact roadmap, step by step, in simple language, so that by the time the video ends, you'll know exactly what to do starting tomorrow. One thing, I'll say it straight, just saving alone doesn't make anyone rich. Saving isn't a bad thing, but it's not the destination. It's only the beginning. Why? Because saving and investing have different jobs. Saving keeps your money safe. Investing puts that money to work. But this doesn't mean you should invest all your savings today. That could also be a big mistake. And that's why the steps ahead are very important. And here's where wealth starts to build. Here's something many people miss. No matter how much money you save, if it isn't growing, its speed will always stay limited. That's why the goal isn't just to pile up money. The goal is to put your money to work for you. Let's take an example. You have $15,000. You put it in a normal savings account that gives 2% interest. 15 years later, you'll have $20,200. Now that same $15,000, if invested in a market-linked fund with an average 9% return, then 15 years later, it could become $54,600. In simple terms, a market-linked fund means an investment whose returns move up and down with the market. If the market performs well, the investment can grow too. That's why, over the long term, it has more growth potential than a savings account. Same money, same 15 years. The only difference was one decision, where the money was kept. And here's a powerful thing to remember. Between people who build wealth and people who don't, the biggest difference isn't salary. The difference is whether their money is working for them or just sitting in an account. Now a question arises, if the difference is this big, why doesn't everyone invest? The real reason: fear, not facts. Maybe you're wondering, if investing is this powerful, why doesn't everyone do it? The answer isn't math, it's emotion. A savings account is like a locked room. Whatever's inside stays there, no surprises. But investing is like an open door. Sometimes sunshine, sometimes rain. Sometimes up, sometimes down. And these ups and downs scare new investors. But understand this. Temporary ups and downs and permanent loss are two different things. Every small market movement isn't danger, but to new investors, both look the same. That's why the shift from saving to investing doesn't happen in a single day. And that's why we'll now understand it step by step. And believe me, the very first step isn't investing. It's something even more important than that. Step 1. Build your safety wall. Now, the first step, and this step, a lot of people skip it, but this is where strong investing actually begins. If this foundation isn't solid, all the steps after it can turn out weak too. Before any investment, you should have 3 to 6 months of expenses in cash. This is called an emergency fund. In simple terms, this is money set aside only for emergencies, not for investing, not for vacations, not for shopping, only for when life throws a sudden surprise, like losing your job, a medical emergency, or a big car repair bill. Here's something most people miss. People sell their investments less because the market fell and more because of an emergency, because they need cash right away. That's why an emergency fund protects your investments not from the market, but from your own life situations. And once your emergency fund is ready, even if the market falls, you won't need to break your investments. What to do? Write down your total expenses for 1 month. Now, multiply it by 3 and then by 6. That range is your emergency fund target. Until it's complete, don't rush into investing. Only after that, move to the next step. Step 2. Create 2 separate buckets. Now the second step. Very simple, but it's a game changer. Split your money into just 2 categories. First, safety money, and second, growth money. Safety money is what stays in your emergency fund. Its job is to keep you safe. Growth money is the money that gets invested, and its job is to grow over time. Remember this simple rule. Safety money is meant to sit still. Growth money is meant to grow. That way, even if the market drops, you won't panic because you already know this is growth money. Ups and downs in it are normal. This is where people make their biggest mistake. They treat both types of money as the same and then panic during every market crash. When your mind is clear on the role of each, your emotions stay in control too. So, starting today, keep these 2 separate, both in your mind and in your accounts. This small change can save you from a lot of bad decisions later. Step 3. Don't wait for a big amount. Now, the third step, and maybe this is the most common myth, a lot of people think starting to invest requires thousands of dollars. The truth is exactly the opposite. Today, many brokerage platforms let you start with just $40 or $50. In other words, what matters most for getting started isn't a big amount, it's a big decision. Here, the goal isn't to get rich in the first year. The goal is to build a habit. Because in investing, more important than the perfect amount is perfect consistency. One more thing. A lot of people keep thinking, I'll save a little more. I'll start next month. I'll start after my bonus comes. And in that waiting, many years slip by. Remember, while waiting for the perfect time, many people never start at all. And in investing, the most expensive mistake isn't a wrong start, it's a late start. What to do? Open an account today, even if your first investment is just $40, because the hardest part is taking the first step. Step 4. Choose simple things. Now the question comes, where to invest? This is where a lot of beginners go wrong. They jump straight into day trading, options, or start chasing crypto because they think the harder the investment, the more money they'll make. But the reality is exactly the opposite. The simpler the path, the easier it is to stick with. That's why a popular option for beginners is an index fund. Let's understand it simply. Imagine you buy shares of one company. If that company performs poorly, your investment gets affected too. But in an index fund, it's not just one company. It has hundreds of companies together, meaning even if some companies underperform, the rest can balance it out. Meaning you're not betting on just one company, you're betting on the growth of the whole economy. That's why long-term investors like it. In the USA, low-cost S&P 500 index funds like VOO or VTI are fairly popular examples. But there's one more thing many people forget to check: the fund fee. In simple terms, this is a small management charge taken every year, charged to run the fund. It sounds small, but over a long time, it can eat up thousands of dollars. For example, if the fee is 1% on a $15,000 investment over 25 years, nearly $28,000 could go just into fees. So along with checking returns, checking the fee is just as important. Always look for a good fund with a low fee. Step 5. Don't stop. Real number proof. Now let's get to the step that looks most boring, but is actually the most powerful. Keep investing every month, whether the market is up or down. Because in long-term investing, consistency beats speed. Let's say you invest $400 every month, and the market averages a 9% return over the long term. 22 years later, you'll have roughly $285,000. Now look closely. Out of your own pocket, you only put in $105,600, but the remaining, roughly $180,000, you didn't earn by working. That money was earned by your money. This is called compounding. In simple terms, compounding means the return you earn today starts earning its own return tomorrow, meaning your money starts creating new money for itself. That's why Einstein is often quoted as calling compounding one of the most powerful forces in finance. Whether that quote is authentic or not is debated, but the power of compounding itself is very real. And the more time you give it, the bigger its effect becomes. Here's another example. Two people, both invest $400 every month. Both get an average 9% return. But the first person starts at age 24, and by age 60, he has $1.02 million. The second does everything the same, only starts 10 years later, at age 34. By age 60, he only has $490,000. Just 10 years of delay creates a difference of over $500,000. So the biggest advantage in investing isn't more money, it's more time. So, the amount can be small, but never let time be small. What to do? Decide on an amount and invest it every month. Don't change your habit based on what the market is doing. Now that question that comes to every new investor's mind, what if the market crashes? First of all, understand this. Market drops are normal. Historically, this has happened many times, and every time over the long run, the market has recovered too. This doesn't mean every recovery happens at the same speed, sometimes fast, sometimes slow. That's why long-term thinking matters most. Here's an interesting thing. When the market falls, that same monthly investment gives you a chance to buy more shares. In simple terms, before, if $100 bought you 5 shares, after the market falls, that same $100 might buy you 7 or 8 shares. And when the market recovers, those extra shares boost your growth even more, meaning that same $100 can do even more work after a market drop. That's why experienced investors aren't scared of every dip. They see it as an opportunity. Remember, a falling market isn't the problem. Selling out of fear is the problem. Very often, it's not the market that causes the loss, it's our own haste. What to do? When the market falls, don't panic, don't pull out your investment, and keep your monthly investing going. Step 6. What order should money go? Now, a step very few people follow, but over the long term, it can make a difference of thousands of dollars. It's not just how much you invest that matters. Where your money goes first matters just as much. The question is, when your paycheck comes in, where should the money go first? Step number 1. If your company offers a retirement match, take full advantage of it first. In simple terms, a retirement match means if you put a portion of your salary into a retirement account, your company adds extra money into it too, meaning it's practically free money. And skipping free money is almost like giving up a part of your own salary. Step number 2. If you have high interest debt, like a 20% credit card, pay that off first, because a guaranteed 20% loss is bigger than a 9% return. And step number 3. Now comes tax-advantaged accounts like 401k, IRA, and HSA. In simple terms, these are accounts where the government gives you certain tax benefits to encourage people to invest for the future. That's why taking advantage of them is quite important for long-term investors. And the HSA, many people ignore it, even though it's one of the accounts where you can get the biggest tax benefit. Remember, investing in the right order is a strategy in itself. Step 7. Make it automatic. Now let's get to a step that's simple and powerful. Make your investing automatic. Here's a fact. When people decide every month on their own whether to invest this time or not, they often skip it. Sometimes a bill comes up, sometimes they're shopping, sometimes it feels like, I'll do it next month. And slowly, investing stops. But when money gets invested automatically the moment your salary arrives, there's no decision to make at all. And because of that, people stay more consistent. The fewer decisions you have to make, the better your financial habits stick. Remember, wealth isn't built by knowledge alone. It's built by consistency. What to do? Today, set up an automatic monthly transfer in your bank or brokerage account. Just once. After that, the system works for you. Now, an honest point. Maybe you're watching this video and thinking, I'd invest, but what's even left to invest? If truly by the end of the month nothing is left, don't stress. You're not alone. And that's exactly why a lot of people never even start investing. But in that situation, the first step isn't investing. The first step is finding just one small expense each month that can be cut, or building a small extra income source. The target is just one thing. Save at least $20 or $30 every month. Remember, in the beginning, the amount doesn't matter. The habit does. And once the habit is built, increasing the amount becomes much easier. Financial freedom often starts with one small saving. Step 8. Invest only what you understand. Now, one last investing rule, which is perhaps the simplest, but the most ignored. Before putting money into any investment, ask yourself, can I explain in 2 lines what this investment actually does? If the answer is no, then don't put money into it. If you need someone else's video or advice just to answer that, maybe it's not yet the right time for that investment, even if everyone's talking about it or social media is praising it. Remember, you never build confidence in something you don't understand. And where there's no confidence, panic comes quickly. What to do? Before investing, spend at least 5 minutes researching, understand it, then invest. Step 9. When income rises, raise investments, not lifestyle. Now, the final step, and this step decides whether you become wealthy in the future or just earn a higher salary. Whenever income increases, often lifestyle increases too. A bigger car, an expensive phone, a new house, and a few years later, income has doubled, but savings stay the same. This is called lifestyle inflation. In simple terms, the more you earn, the more you spend. That's why some people earn a good salary for 20 years and still never get close to financial freedom. And that's why a lot of people, even with a good salary, never build wealth. Before every big purchase, remember this: every dollar spent today isn't today's expense. It's also a missed chance to grow in the future. Ask yourself, do I really need this? Or if I invest this money instead, will it work harder for me in the future? What to do? Whenever your salary increases, send a fixed portion of that raise straight into investing before increasing your spending. If you've watched the whole video, quick recap, what exactly to do now? You just need to remember these 9 steps. And if you honestly follow even half of these steps, your financial position a year from now will look different from today. Step 1. Calculate your monthly expenses and build a 3 to 6 month emergency fund. This is your financial safety wall. Step 2. Split your money into 2 parts, safety money and growth money. Each has a different job. Step 3. Don't wait for the perfect time. Start investing, even with a small amount. Step 4. Choose simple investments, like low-cost index funds. And before investing, always check the fee. Step 5. Keep investing, every month without stopping. This is where compounding starts to work its magic. Step 6. When the market falls, don't panic. Long-term investors win not against the market, but against their own emotions. Step 7. The moment your salary arrives, make your investing automatic, so consistency never breaks. Step 8. Any investment you can't explain in 2 lines, don't put money into it. And Step 9. When your income increases, don't just increase your lifestyle, increase your investments too. That's it. It sounds simple, but sticking to that simplicity for years is the real challenge. Now, let me summarize the whole video in just 1 minute. Saving isn't wrong, but saving is only the first step. The real game begins when your money starts working for you. So, first, build your emergency fund. Then, choose a simple, low-cost investment, and in it, every month, invest automatically. And then, do the hardest thing. Do nothing. Don't keep checking your portfolio. Don't watch the market every day and change your decisions. Let time do its job, because wealth isn't built in a day, but with the right system, it's built every single day. And remember, you don't need to beat the market. You just need to stay in it for the long run. And one day, you'll look back and realize the most important decision wasn't how much you invested, it was when you started. If today's video made your investing roadmap clear, do one thing. In the comments, just write, "I'm starting today." This won't just be a comment, it'll be a small commitment to yourself. I want to see, after this video, how many people don't just learn, but also take action. And if you want to understand finance in simple language, step by step, then make sure to subscribe to the channel. Because here, we don't just share theory, we share financial knowledge you can actually use in real life. Remember, saving keeps you secure, investing sets you free. And the sooner you get both working together, the sooner your future starts to change. The best time to invest was 10 years ago. The second best time is today. See you in the next video.